Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have provided North Florida savers and investors sound, comprehensive financial guidance for over 25 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into Financial Focus, brought to you by the best of the best in financial services, 7 years and running, as named by the readers of the Lake City Reporter. They are the team from GulfCoast Financial Services. Founder, CEO John Kuykendall here with us each and every week, providing us a common sense approach to planning for our financial, our investment, and our retirement future. And today, John, a little bit about our tax future. We're going to continue our discussion, everybody's favorite topic, taxes, but it is on people's minds. So let's talk about what we need to do about them while people are thinking about them.
Well, that's right, Peter. It's right on the forefront of everybody's mind. But again, we want to alliterate that we want to specialize in tax planning, not tax preparation. Tax preparation is taking what you did last year, putting it on a piece of paper and telling you how much you owe. Tax planning is figuring out what you did last year and then figuring out how we can save you taxes going forward. And tax planning needs to be done throughout the year. If anytime during the year you sell a piece of property, you sell something, you need to go back to the tax professional and get that analyzed to see how it's going to affect you. So many people are so concerned about getting that refund check. I don't know how many clients I have, they get real excited when they get $5,000 back from the IRS, and I have to explain to them, it's their money anyway.
Yeah.
The IRS has just been holding it for them all year and not paying them any interest on it. But people get really excited about that, Peter.
If the roles were reversed, if we were holding the IRS's money all year, I bet they would charge us some interest.
Well, don't they, Peter? Because if we don't pay in enough, they penalize us, right?
Absolutely.
So they do charge us interest, but we let them have it free.
Yep.
It's this feel-good mentality.
Well, I think a lot of people get excited by getting that lump sum. Some people use it as almost a forced savings account. They know they're overpaying. They're making this decision to not let their money work for them consciously and on purpose, John.
Well, that's just amazing that people do that. But you're right, Peter. It is a forced savings account. People understand that they're putting too much in it. And for some reason, people have an aversion to coming up at the end of the year and having to pay $1,000 or $2,000 in because they cut it too tight. I don't understand what the mentality is that says, the IRS is going to come after me if I owe them any money. As long as you pay them, they don't care. It's crazy. It just doesn't make sense. But people do that.
We know that the time that we need to pay them is coming up right around the corner. Now, oftentimes the actual date falls on a weekend or on a holiday or something, and it's changed a little bit. So this year, it's not the typical April 15th that is commonly known and advertised. It's actually going to be Monday, April 18th.
Mm-hmm.
By now, John, most of the forms have shown up for those that are really on the ball and proactive. Some of us may have even already filed some returns, but sometimes we do need to sort of pump the brakes because the forms can continue to come in. And this year, maybe unlike any other, John, there has been a lot of delays. The major financial institutions have even talked about delays in getting some of those forms out. So we may need to have just a little bit more patience jumping the gun, but not so much that we are delaying past that date.
Well, that's right, Peter. And one of the things too is that a lot of the custodians where we house our money for our clients, they issue corrected 1099s. And so we don't want to file those taxes so early that we have to do an amended tax because we got an adjustment to a 1099. And you're right, in this day and age with everything that's going on, shortage of labor, everything else, everything is slowed down. So you got to just take a step back and analyze what you've got in, get with your financial professional, get with your tax people, and make sure that you're not pulling the gun so quick because you just want to get it over with. Also, don't forget that on March the 1st is the deadline for you to make your fourth quarter estimated taxes. If you're estimating your taxes, you have to have that in by March 4th if you haven't filed your return. A lot of older us retirees, we're on that quarterly tax system. So we don't withhold from our Social Security. We just make an estimated payment every quarter. So that's March the 1st. We have to get that in. So make sure everybody gets that number done.
And some procrastinators may even wait till April 17th to start on this. Some may file an extension, John. Now, important point to note, that is an extension of the paperwork only, not the payment that would be due, that paperwork would help you calculate. So you have to make that payment. Otherwise, again, the IRS, you're holding their money past the time that it's due. They're going to charge penalties and interest.
Well, it's amazing that a lot of people feel like if I file an extension, I don't have to pay my taxes. But the thing is you got to estimate the taxes then, which leads you to making a mistake and having to pay a penalty. But that estimated tax payment has got to be in when you file that extension. Just because you file an extension doesn't mean that you're prolonging the payment to the IRS. That doesn't work that way, Peter. We know that. Procrastinators
of the world unite tomorrow. John, we know some of the forms. You have sent along a very helpful 13-page resource guide, noting that this is not comprehensive, but it seems like for every circumstance that we could imagine, there is a tax form for it. Now, we know that the tax return document sets the 1040. If we've got a pretty simple situation, maybe we even get to default to the 1040 EZ form. The W-2 is the wages that we are paid that have basically already been washed through the tax cycle before we receive our money. The IRS sort of already oftentimes takes their bite out of that. But the big one for retirees is 1099s. And there are a lot of different 1099s for various reasons, but the 1099 is a big one. And then the 5498 is another one that a lot of people have questions about. Hey, where is my tax form? And what do I even need to do with this 5498 or this 1099 if I rolled over an account and I don't have a corresponding form?
That's right, Peter. And, a lot of people make that mistake. They don't get the forms. They don't hold on to them. And so when they file their taxes or when they go to file their taxes, they end up getting penalized. And the IRS treating that as you cashed out, you didn't roll it over. So those forms are very important, especially the one that comes on the back end from the company where we took the money from. The 1099s, like I said, those are going to be corrected several times. TD Ameritrade historically does corrections once or twice before they finally get it right. So you need to make sure that you hold off and get your financial professional to help you with that. But the thing about it is the 1040 EZ, I didn't realize this, Peter, but it's only for people under age 65. Mm-hmm. So if you're over 65, which the majority of our clients are retired, you can't use the 1040 EZ anyway. So you're going to have to use the 1040 or And then the other one we want to make sure of is that Schedule D, that you've got your capital gains and losses put on that Schedule D. So if you're doing your taxes yourself, make sure of that. If you're letting GulfCoast Financial Tax Service do that for you, we'll make sure that's covered. And for all of our clients, we provide all the information directly to the tax preparer for those forms.
Now, if you are preparing the taxes, in other words, putting together the document to let your last year's income sources and payments all be recorded, John, obviously you've got to know each and every one of these forms for various circumstances that may fall in, that income may have been generated from, or losses or gains, or a myriad of other sales or trades or transactions. if you are planning and looking forward and trying to control lifetime tax liabilities from the financial decisions you are making now and into the future, you really just need to know what events can cause taxation and what category they would fall into, and then try to control those kind of events as much as possible.
Well, that's true, Peter. And I think this list here is pretty concise in telling you what each form does and telling you the form you'll need. Like with a 1099-C, that's for cancellation of debt. And it says on this form is issued when a lender or creditor discharges a debt that is owed.
Now, important point to note, they just canceled a ton of student debt. And I know not everybody is this going to apply to, but I think I heard something like 75 million. Those individuals might end up getting one of these forms come tax time next year.
That's right. They may, because it is income that they've received because their debt was canceled. So, I would recommend that anybody out there listening that wants this list, we'd be more than happy to provide it to you. It's a concise list, tells you exactly what the form's for, and then it does an explanation of the form. I think it's a great form, Peter.
Well, John, we hear a lot about controlling taxes. We hear about the different forms of income, and we hear that active income versus passive income, that these ultra rich, the wealthy, have more passive income. In other words, investment income. Active, we are actually out actively earning the income. And that seems to be the kind of income that's taxed at the highest rate. But point of note, when we don't spend all of our money and contribute it to some kind of qualified retirement account, like a tax deferred 401k or IRA, that is not passive or investment income. That is simply deferring the taxes on the active income till a later date.
Yeah, that's right, Peter. It's kind of like, as we said on the show before, I can get taxed on the seed or I can get taxed on the harvest. So what these people who have put all this money up, which honestly we've told them to over the years, this is the seed of their money. Now that money is grown, compounded over many years, and now that's the harvest. And so when we're harvesting it, we're harvesting passive income, not active income. And so certainly it's nothing that we're actively managing or actively earning. It's just passive income. And passive income, unfortunately, all this money that's deferred, now we're paying taxes on, that's going to create a lot of tax problems for us, because if we're already getting other sources of income and then all of a sudden we were at 72 and we hit that minimum distribution and all that money is forced out, then all that becomes just bumps me into another tax bracket and creates a whole bunch of new headaches for us.
Yeah.
That's one of the reasons that we're using a lot of our clients. We're advising them to do their charitable contributions out of that required minimum distribution so that it doesn't count for income.
Yeah. Well, on last week's program, we talked a little bit about the whammy, the double, the triple, the quadruple whammy of deferring and delaying paying taxes. Not only are the taxes due later, but the Social Security can become taxable. The Medicare can increase. And then you've got those RMDs you've got to deal with. And the seed and the harvest concept, that is really retirement money. And we've got to understand the choices that are now available. We didn't always have those choices. The Roth is a little bit of a newer iteration. It's been around for a while now, but a lot of people still are only just now learning about some of the values of that tax-free bucket, that post-tax, now tax-free Roth category. But either side of that equation, John, there are some qualifications, limitations, and restrictions if we categorize our money as retirement money, whereas we could make after-tax investments and have maybe not the same type of advantages from a tax standpoint, but still pay less in tax because it's investment that has already been taxed once, and have a little bit more flexibility along the way. So if we've hit certain limits or limitations with how much we can get into savings and investments in retirement accounts, that doesn't mean we can't save or invest any more money. Maybe we just need to do it in a non-qualified after-tax kind of category, correct?
That's right, Peter. I mean, we don't need to stop just because we're out of our deferred category. I mean, actually, we should be doing the Roths now instead of doing the IRAs, the 401k. Should be a 401k Roth. The problem is if you're 65 or older, you can't afford to do a Roth conversion because it's going to throw your Medicare and your Social Security taxes up. So we've got to get the younger generation now to start doing those Roth conversions, paying the taxes now, biting the bullet, and then having more money in retirement that we can actually manage. And if you've already, there are municipal bonds, there's life insurance, there's annuities, other things that we can put our money into. So just because we've maxed out our 401 or maxed out our 7,000 or 6,000 on the raw IRA doesn't mean we can't do other things, and we should do it. We're going to need as much money in retirement as we can get. That's for sure. Mm-hmm. And, now we got this double whammy because in 2027, the tax law sunset, and we go into even a higher tax bracket unless something happens. And I don't see that happening. I don't see us getting lower taxes. I think that's going to sunset and we're going to be back where we were. So, it's just creating a real compounding whammy or effect on retirees, that and the fact that inflation's eating away at our income.
Yeah. And when that Tax Cut and Jobs Act break expires, the 12% bracket goes back up to the 15, the 22 becomes 25, and the 24 becomes 28. Well, what that says is that if we're in the 22 right now, we've got a whole nother current bracket that is still lower than what those tax rates are going to be when it changes. So if we're talking about where is the future of taxation, what is the direction it's going to go? It's going to go up. And right now we may have a good amount of wiggle room before we end up paying more than we're likely to pay in just a few short years.
Well, that's right, Peter. And I mean, there are still some tax maneuvers and some tax things that we can do. We can go ahead and pay the money now, like I said, on some Roth conversions. But the time's running out. I mean, it won't be that long before that Jobs Act sunsets and we get the higher taxes, unless the administration changes them even quicker than that, which that could happen also.
Now, John, if somebody's got a $2 million tax deferred IRA, you're not proposing that they run out and convert all of that over the next few years. That would definitely put them in a substantially higher income and tax kind of echelon, kind of tax bracket. But being strategic, crunching the numbers, there are opportunities if we're looking for strategic opportunities to control and minimize our lifetime tax liability. Thinking about a Roth conversion over the next few years probably presents one of our best.
Well, that's right. And with our software, we can input your taxes now. We can show you what's going to happen if we do the Roth conversion, and we're going to show you how much taxes that's going to increase. We can also show you how it's going to affect your Medicare and your Social Security if you're in that situation. But yeah, we need to be proactive, Peter. We need to not certainly take all $2 million and convert it today, but there may be a way we can do 200,000, and maximize or minimize the taxes and maximize the gain.
Again, a lot of wiggle room between where the current brackets are and where they are going to be in just a few short years. If something's on sale today, and I know it's going back up to full price or increasing in price in just a short time, John, especially with taxes, which I am going to be forced to pay one way or another, I'm going to get them while they're on sale. So again, talking about strategic opportunities to control our tax liability with John Kuykendall, president and founder of GulfCoast Financial Services, making ongoing contributions to tax advantaged accounts, a great opportunity, considering those conversions. And John, up until that tax filing deadline, we talked about our limits and limitations, but there are some ways that we might be able to multiply the amounts that we get into tax advantaged accounts and maybe utilize those Roths a little bit more.
That's right, Peter. And that's what we like to do here. We like to take that software, analyze it, give you the scenario, and then work with you. We've done that several times, many times with our clients, and it's been very proactive. Also, if you've got gains, if you've got a huge gain in a stock portfolio that's not in your retirement account, or if you've got property you've been thinking about selling, now may be the ideal time while capital gains are still low. Capital gains are going to change. They're certainly going to change in 2027. They're probably going to change before that. So we need to take advantage of some of those things that we can do, certainly by doing some things now to make things better. That's just the way it is. Peter, a lot of talk lately about the government's coming to get my money.
Yeah. I was going to ask you about some of the marketing that I've heard that they are coming for my IRA. They are coming for my retirement. What do you make of all that?
Well, I make it as, it's hype for one thing. Everybody's got their 5 minutes of fame, and that seems to be the bandwagon right now. We were on the thing that, bank regs were going to change and your bank was going to take your money. We got off of that when the regulations didn't change such that that was a reporting thing where they thought they were going to have to report down to $600 or something. And everybody was upset about that, which didn't make a lot of sense. This reminds me of the time that there was an advertisement and it said, so-and-so and so-and-so says that the stock market's going to crash. And now's the time for you to get out of the market. And down at the bottom, it said sponsored by the Diamond and Gold Exchange. Mm-hmm. Now, the IRS they aren't coming for your money. They're coming to get the taxes, and they're going to get the taxes, and they're going to take that just like they always have. But it's no different than what it's ever been. Yeah. It's just that, like I said, we know more about planning now. We know more about how to maneuver some of this money around. And there is better ways to have it than having it all in a deferred account. But the government's not going to take our money. I mean, that would create, the American Revolution Part 3. Yeah. So we're not going to do that.
Yeah, they would see problems from a whole different side of America if they confiscated these retirement dollars just holistically. But there are $30 trillion plus in yet to be tax deferred retirement accounts. And they are going to get their pound of flesh one way or another. That has always been the deal. The issue, I think, John, is that the rate at which they take that money, the tax rate when you withdraw, that is adjustable. They get to make those rules. And so
they get to make them.
If they just raise rates, they have confiscated a little bit more of our wealth.
But, also, Peter, you got to understand, we're at the lowest tax brackets in history. This is the lowest taxes that anybody will pay. And I know we don't understand that. And I hate to pay taxes like anybody else. But there was a point in time where we were paying 94% was a top tax bracket.
Yeah.
After World War II. I mean, hey, we're not there. So we should be thankful for what we've got, but we should also prepare for the future and know that taxes are going up.
Two things. I heard that Ronald Reagan, that was his actual reason and motivation to get into politics in the first place, is that he was paying upwards of 90% in tax if he made a third movie within a year. And he said, this isn't right, got into politics. And then
well, Ronald Reagan, that they didn't make a lot of money back then for movies, but the tax brackets were such that as they made money, they had to pay. And certainly, we're in a better tax situation than Ronald Reagan was. And we should be thankful. But the problem is we got this tax cut back during the last administration, and it was to help us save more money. But the problem is we haven't been saving any more money.
Yeah.
We've just been thinking this is utopia, and utopia is going to end.
Yeah. The other thing, John, was that I heard someone recently, and I don't know this, the source, I can't remember who, but they stated that if you can get your dollars out of tax deferred accounts at less than a 25% bite, less than a 25% tax hit, that is a fantastic deal and you should take it. And again, here into the very near future, the 22% bracket is going to become the 25% bracket.
Mhm.
So there's opportunity to do it right now here today that might not be around forever. When I heard that and I was like, wait, I only get to keep 75% of my money. It didn't sound fantastic, but in fact, the more I reflect on it, I can't credit this properly, but whoever said that was probably correct. That it is a pretty good deal in reflection of what tax rates have been.
Yeah. And what tax rates will be. I mean, taxes have to go up. We have to pay for this debt that's been issued. We have to pay, we got to pay the interest. So interest tax rates have to go up. There's just no way around it.
I'm just going to credit it to you, John. I heard that wisdom from you. Good job. Well, look, as we continue through our financial planning and progress, we want to build wealth and we want to find ways to be smarter with our money. And tax season represents kind of a continual reminder that, hey, we still have more to learn. We still need to get a little smarter. We want to keep as much of our money as possible. And that's why, John, you offer the complimentary review, the financially focused retirement income plan. And when you're talking about creating income in retirement by nature, de facto, you are going to discuss and understand and learn and educate yourself on tax implications of that retirement income as well.
That's right, Peter. I mean, that's one of the things that we do here. We like to go through the tax software, go through the planning software, figure out where you run an income plan and tell you where you're going to be and how you're going to fund your retirement. Or if you're in retirement, how you're going to be able to continue to live the retirement you want. Social Security is certainly not keeping up with inflation. And we know that. And so somehow as inflation continues, and it will, we need to be able to get more income. That's one of the things we do here is trying to figure out how to maximize your income during retirement in a sustainable, predictable way that you can live the kind of retirement you want to live.
Well, GulfCoast Financial Services, they help savers and investors build that wealth, preserve that wealth, protect that wealth, and keep more of their wealth through strategic planning and that financially focused retirement income plan. If you'd like to get that put together, if you'd like to take a look at the fees that you're paying, the risks that you're taking, the taxes that you may be liable for, and the results that you are hoping for, the goals that you have with your money to make sure you're on track to achieving those, pick up the phone, give GulfCoast Financial Services a call, and request that time and opportunity to sit down with John and his team for that strategic strategy session, the forensic financial review, the financially focused retirement income plan. 386-755-9018. That's 386-755-9018, 386-755-9018, or you can visit online, GulfCoastFinancial.net, GulfCoastFinancial.net. John, I'm sure we'll talk a little bit more about taxes from time to time here on the program, but a great conversation for today.
It was, Peter. It was a great conversation, very timely. I hope people will take advantage of the idea that we can help them and come in and let us do a plan for them.
Well, we appreciate the time. As always, great to see you. And ladies and gentlemen, if you'd like proactive guidance and perspective on achieving your financial goals, pick up the phone, give a call to GulfCoast Financial Services, named Best of the Best in Financial Services by the readers of the Lake City Reporter 7 years a row and running. 386-755-9018. And we appreciate the time here on Financial Focus.
Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.